if you're not registered with DAO1. Type 1 if you do own any products, so either mining bots or trading bots. And type 2 if you are someone who is also actively structuring and referring in order to create income and structures from DAO1 and the DeFi space. So 0 if you're just here and you're brand new, 1 if you own some sort of product, 2 if you are referring and growing a structure and income from DAO1 and APTM. Okay, awesome. We've got a mix of people, which is great. 1, 1, 2s, 1s, and 0s. Okay, fantastic. All right, well, with that as the starting point then, let's maybe zoom out and share some general information and then start looking at some detail. We're going to be looking at DAO1 products and services today that are designed to accumulate APTM. So when we talk about things like trading bots and mining bots, we're essentially talking about hard-coded programs that are executing actions according to code, not according to sentiment, people, political structures, the weather, whether a market is up or down. We're going to go and look at what those programs do. When we talk about DAO1, we're specifically talking about a platform that's built on a blockchain. So the blockchain that we're looking at that's executing these rules, that has its own coin representing value of those rules, is a blockchain called APTM. And we're going to be looking at that blockchain today, and we're going to juxtapose it to the Bitcoin blockchain. The reason being that the same rules that we see in Bitcoin, we see exercised over here in APTM. These rules, as many of you know, possibly when we talk about rules, we talk about something called tokenomics. These are hard-coded rules into a blockchain, and those rules execute certain instructions, and the result of those instructions against a growing community is what results in something called tokenomics. So if we look at Bitcoin's tokenomics, we get a good example or a good idea of the potential that APTM is on. So just 3 basic tokenomic rules that we need to understand exist in both blockchains. Bitcoin has something called a fixed supply of 21 million, meaning you can't produce more than what the code allows. There'll only ever be 21 million Bitcoin. APTM has 2.1 billion as its fixed supply. So they share that rule. The second rule that they share is something called block emissions, meaning that every time a block is created in the Bitcoin blockchain, so just picture building out a super highway for moving value. That highway is built out block by block. That's how Bitcoin exists. Every time a block is created, a set number of Bitcoin are released to the people who own mining equipment. APTM follows that same rule, meaning every time a block is created in APTM, a set number of APTM are released back to the community who holds mining bots. The third common rule is that the amount of Bitcoin released per block goes through something called a halving, meaning that every 4 years, specifically for Bitcoin, the set amount halves the number, and so suddenly the mining community is receiving half than what they received before. That same rule exists for APTM. The difference is that instead of time-based, it's block-based. So every 125 million blocks, the amount of APTM being released to miners halves the number. Those are 3 common rules. And the reason why we want to understand those 3 common rules is that we want to take the data we see in Bitcoin, we want to take the learnings or the blueprint we see in Bitcoin, and from that, we can then make some assumptions about the potential for APTM. Now, the reason why we want to start with understanding fixed supply is that if we were to put that into a calculation, just a basic math calculation, if you have a fixed supply with a fixed release protocol, then the only way that that thing can grow in value is if you increase the number of people using that blockchain. You increase the number of people who want access to the coin of that blockchain. And so what I wanted to do in this first part of the call is I want to go into Bitcoin. I want to go into a page that you can all go look at for yourself, because you don't know me from a bar of soap. I don't know you. So the trust currency is low here. I would much rather work on data. And so I'm going to share the site you can go to, look at the same figures we're going to talk about now. And from that, 1, get what we call hindsight. And two, manage expectations. And from managing expectations, we can then as a community put in structure, systems, strategies to actually benefit from what we're sitting on. So if that's okay, just raise your hand to say, yeah, that's the journey we're going on. And then what we'll do is off the back of this journey, we're going to open it up to, let's get some nuanced questions. Let's look at some of the detail that we're looking at together. So I'm going to share my screen with you. Moni, can you manage the microphone? Sorry, I'm just cognizant of, we've got a short window together, so we're going to all need to dial in without distractions. And then secondly, can you make me co-host or host, Moni, so I can share my screen? Amazing, thank you. I'll just send a little request. Okay, awesome. All right, so the site we're looking at, so you can go do the same exercise. We're looking at BitBow. If you want to go specifically into the page we're looking at, it's charts.bitbow.io, and we're looking at a section called the price chart. We're specifically looking at the Bitcoin price chart, and we're looking at 2009, so October the 5th, 2009, all the way to today, which is October the 20-something. I need to kind of get into that, but October the 20th, so this needs to update, once a week. The reason we start here is it gives us this useful tool at the bottom, which enables us to get snapshots of Bitcoin. And the snapshots that I want to focus on today is what we call 3 to 5 year snapshots. And you'll see pretty quickly that there's a rhythm that exists within cryptocurrency that becomes useful to know. So I want to take us into the first 3 year snapshot, which is 2012 October. So where are we? October, there you go. October 2012, October 2009. That's our 3 year window. Now, let's have a look at something. We're looking at Bitcoin, which is a fixed supply coin, and it has a fixed release protocol. And what we see, if we look at the early days of Bitcoin, is Bitcoin being mined, so blocks being formed, but there's no price discovery. All of October, all of November, all of December, all of January. In fact, the first time we see price discovery is at 1 cent in February. I'm trying to get there. There you go. February 28th at 1 cent. How does something suddenly get price discovery? Well, if you've got a mining community who's mining Bitcoin, currently every person who owns Bitcoin cannot sell it to each other because they each own it. There's no outside demand. There's no outside conversation. There's no person going, I should be involved in this. You're at what's called a break-even point. Fixed supply, fixed release, fixed community having a conversation. And that happens for 4 to 5 months of Bitcoin's first 4 to 5 months. Suddenly, the conversation goes outside of that circle and someone arrives and says, well, I don't have the knowledge to mine. In other words, I don't know how to set up a hardware processor. I don't know how to aim my graphics card at code. I don't know what you guys are doing, but the conversation's interestingly enough that I will buy some Bitcoin from you. All that happened in February 2010 as the conversation got bigger than just the mining community. Fixed supply, fixed emission, increase in demand. And so we have something called price discovery. And we see this conversation getting bigger and bigger as we see the price increasing. Fixed supply, fixed emissions, which means the only part of the equation that can cause an increase in price is if you increase the demand. Simply put, the conversation just got bigger than when the community first started. Now, I like to ignore these big hype spikes. I can tell you that there's a ton of people who get involved in cryptocurrency because of hype and headline. They also happen to be the majority of people who lose money. And so we're going to look at these 3 to 5 year windows, and we're going to see that the majority, the 97%, ironically, tend to buy cryptocurrency when it's hyping or headlining. In other words, their attention is on it. And so the result of that is obviously lack of education, lack of understanding of supply and demand. I mean, generally, the miners are going to sell against that hype, realize some profits, and these people are going to have what is called a negative experience. All the way from June 2011, all the way down to November 2011, they have a 5-month negative experience from $26 down to $2. That's a bit like looking at APTM in the last 2 months, going from $1.80 down to 18 cents. Just to, like for like apples over here. 5-month journey in Bitcoin, 10x down. The Pertums had a 1.2x down journey in the last 2 months. Hype, headlines, worst time to buy or trade something, right? Buy it at the top, sell it at the bottom, lose money. What's more interesting is what's happening after the hype bubble. The community just grew. The awareness just grew. How do we know that? Fixed supply, fixed release, bottomed out at less than $1. It's now sitting at $2, $3, $4, $5, $6. This climb is what interests us. The only way the value on a fixed supply, fixed release coin, the only way the value can grow is if the conversation grows. More people are paying attention and they want that thing that is being released. This is our first 3-year window. 3-4 cents, $10, $12. I told you we'd look at 3 to 5 year windows. So I'm going to take us all the way to 2014, just to keep the conversation shorter than we need it to be. Here we go. October 2014. We've now gone through 2 massive spikes. One was over here, all the way down from $100 and something down, and all the way over here, almost $1,000, so $900 down. Here's the first group of millionaires that we saw in Bitcoin. They were the ones that were accumulating Bitcoin at this period here. 18 months of mining and trading Bitcoin at sub-dollar prices. And now they're sitting 5 years later at a coin that's at $367. All that happened was the demand increased, the community awareness increased, the number of people in the conversation increased. Ignore the hype. Look at the increase based on supply demand. Now we can go and slide the scale in these 3 to 5 year windows and you'll start seeing a pattern. You'll start seeing batches of millionaires who accumulated at one point and rode the supply demand maths calculation in their favor, not the hype or headline based ones. And so you can do this for yourself. You can go and slide it all the way to 2014. And then you can take that same slider on this edge, slide it from 2014 to 2019, October. Okay, so look here, we had a period. So after our first batch of millionaires in Bitcoin at that $200 mark, we saw it then bum around $200 for almost a year. Eventually it started climbing again and we got to that $1,000 mark, but now it's not a spike. We saw growth over a substantial curve period based on the conversation getting louder. More people involved in Bitcoin. Fixed supply, fixed emissions per block, the demand growing, the size of the community growing, the awareness growing, the conversation growing. That's supply and demand. And so it got to 1,000 without a spike. We see it spike again, hype and headline, a lot of people. Their experience of Bitcoin was a negative one. They went and bought at hype and headline. They sold during the dip. When you buy something at a high and sell it at a loss, that's obviously you're losing money. Sorry, Joe, can you just mute yourself there? Let me help out. Maybe Moni can. Thanks. Okay. What's interesting is what happens over this next little period here. Watch this. Lots of sideways movements before we go into a spike. So we had a period of Bitcoin averaging out at $10,000. This, by the way, this $200 to $10,000 period, this is our next 5 year window. It's our second batch of millionaires. If you go back into Google, you go and timestamp it back, go and read the headlines and the stories. Suddenly there's guys who've accumulated Bitcoin, $200, $300, realizing gains into the 10,000s. If we push this again to that same 5 year window period where we saw sideways movement at that $9,000, $10,000 mark, and we push it to the next 5 years, we're then sitting in this 5 year bubble at the moment where we saw it go 9,000, 10,000, another head and shoulders shape, 9,000, 10,000, 20,000, 30,000, 40,000, sitting at over $100,000. This is our current period. We've got our third batch of millionaires suddenly sitting in place. The reason why this exercise is interesting is that we know for a fact, if you go look at the numbers, 97% of people who got involved in these 5 year windows lost money. Generally because they bought at a $26 spike somewhere over here. You can't even see it anymore because it's flattened out in comparison. at a $220 spike somewhere. It's hard to find in this. A $1,000 spike, a $17,000 spike. Each of these spikes are hype and headlines. People lost money. It's the moments in between based on fixed supply, fixed release, increase in demand, increase in community, increase in conversation, increase in awareness over 5-year periods. Why are we looking at this? Because when we're looking at a APTM, we're looking at an 8-month-old coin. Coin, not token. Tokens use someone else's infrastructure to, create loyalty points, essentially, that people can liquidate. That's what tokens are. We see loads of tokens out there. Coins are things that are released directly by the blockchain, and the health or value of that coin represents the health or value of the blockchain that's being used. Bitcoin's health is based on the fact that more people use Bitcoin's blockchain. That's all it is. It's a 16-year-old blockchain. It's a very long established highway that more and more people are using, and so the coin has grown in value. If we go do the same exercise with Ethereum, we will see a 9-year-old highway. We will see it starting at 3 cents and sitting at $4,000+. Same thing. People over time, more people got involved in the health of the blockchain. The coin represents that health. We're looking at a APTM 8 months in, sitting at, I think, 67 cents today. We've seen it at 2.5 cents. We've seen it go through its first hype cycle all the way to $4. We've seen it bounce around between 80 cents and $1.20 for a period. We saw another hype cycle into $2. We see it currently bouncing off the retracement of that at 60 cents, 70 cents, and moving around over there. 8 months into the project. Same rules as Bitcoin. What does that mean? It means 97% of people are probably going to lose money based on coming into projects based on hype and headline. 3% who understand the math are going to accumulate for the next 3 to 5 years. What DAO1 does is it creates two products currently that are accumulation based. If you own mining bots, you're accumulating directly from the source, from the blockchain. And if you understand the math behind the project, you're going to accumulate for the next 3 to 5 years. There's a second product that goes directly to the market, and it accumulates from people selling. How does it do that? It buys a APTM when it's dropping in value, so it fills up the bags when it's on fire sale, and it'll wait for the price of a APTM to climb again before selling that as a profit. That means it does what the 3% do, not what the 97% do. Reality is, if we go look at the entire crypto market, more people are losing money than making money. Why? Because they buy based on hype and headline. They sell based on ignorance, fear, uncertainty, doubt. They buy at a high, they sell at a loss. The trading bot does not have that problem. It has zero emotions. It doesn't give a rip what people think, what they say in a chat group, the opinions people share. It's just going to buy when it's dropping in value. It's going to sell when it climbs in value. That's what it's hard-coded to do. Moni's got you on this call because what I want to do is vision cast into if the same rules exist and we've got products that are hard-coded that understand those rules, then what we've got is an empowered community for the next 3 to 5 years. That's all we've got. So every person who typed 1, you're sitting on products that are hard-coded to accumulate a APTM either from the blockchain or from the market to do what the 3% do. That's the people who typed 1. If you typed 2, you're actually the demand, you're the demand driver inside of the maths equation. If you own a product, you're the supply driver. If you type 2, if you're a referrer, you're the demand driver. In other words, you're the person who goes and starts conversations with people. The reason Bitcoin grew is because the conversation grew, the awareness grew. The reason why Ethereum grew is because the conversation grew, the awareness grew. The reason why a APTM will grow over 3 to 5 years is because the conversation will grow, and there's a referral program put in place that commissions our community. Bitcoin didn't have a commission community. Ethereum didn't have a commission community. Solana doesn't have a commission community. Anybody who's sitting on this group, you're either in control of supply or you're in control of demand. The blockchain itself is built beyond what Bitcoin can do. It's got smart contract capabilities, so developers can build on it. And if that's something you're interested in, you can go have a read on APTM.io if you wish to. It's the official site. You can go into the mainnet component. You can have a look at the Explorer. So this shows number of wallets, number of smart contracts. It shows all coding behind the different smart contracts. This is like nerd heaven if you're a bit nerdy and you love the numbers and the data and the contracts. There's already a decentral exchange in place. What that means essentially is that instead of having a coin sitting on a central exchange where order books are run, in other words, where pricing can be manipulated by whoever the exchange is, this sits on a decentral exchange, meaning that the community decides to buy and sell according to available liquidity. So you can't fudge the numbers here. You can go and look at the burn wallets. This means that unlike Bitcoin, the activity that happens on the blockchain, there's a small burn fee that takes existing APTM from the market and burns it, destroys it, removes it, which means that we've got a deflationary mechanism hard-coded into the rules. There's a wizard. This is for, again, the nerds who love creating their own projects. They can actually build on top of APTM. To give you an idea of what's happening out there, we've got one team that's gone and built an NFT marketplace. So people can create their own art pieces, they can create their own collectible cards, they can create their own NFTs that gives them exclusive access to different platforms. That's all happening on the Wizard. There's a project called Open Plaza that's gone and built that. There's another company that went and built over-the-counter trading platform. Oh, it's Open Plaza. They built an OTC. So people can buy and sell, put in their own bid and sell orders in. Separate to DAO1, built on APTM. There's another company called Sports Future that is building and tokenizing real world businesses and creating a business directory for those businesses. I want you to go back 30 years when we all ran around with phone books in our homes. Actually, this is a bit funny when you start thinking about it. Look, I'm a big believer in data privacy. The irony is, remember 30 years ago, we had these thick books in our homes that literally had people's numbers and addresses in. Anyway, what Sports Future is doing is tokenizing real world companies, bricks and mortar companies, giving them a place where there's now a business directory and people are doing business with each other, all built on the APTM blockchain. So the blockchain itself does more than what Bitcoin can do. It does what Bitcoin does, and it does what Ethereum does, and it does what Solana does, all in one place. Here's the good news without getting hyper technical on this. If you never engage in any of those activities, in other words, if you just hold product, you're already in a massively empowered position because you control supply. All the people who typed 1, you're already privileged and positioned for the next 3 to 5 years. Anyone who typed 2, you're already positioned for the next 3 to 5 years on driving demand. Anyone who wants to launch their own products, they can go use the tools out there to go and do that. That's on you. We've got a developer base that's doing that independently. Here's my point, is that it doesn't need a huge amount of expertise to benefit from what's being built out. And we can take the blueprint of Bitcoin, we can take the blueprint of Ethereum, we can take the blueprint of Solana, and from that pull the data that is true for APTM and start projecting into the future where the potential upside of this is. People are going, when is the best time to get involved in a project? Well, actually, it's about 3 to 5 years in the past. I want you to hold on to that for a moment. Like, if you get involved now, it's because you position yourself for 3 to 5 years from now. I think the mistake we're seeing in cryptocurrency is people are coming in, buying products or putting money into actual coins directly in markets, or they position themselves with certain activity or services, but not putting together a 3 to 5 year plan. We've given the DAO1 community products that run on automatic for the next 3 to 5 years because we know that the accumulation phase is key. And if people understand this, then what they've got is something that will position them for the growth that comes in 3 to 5 years. If you didn't type 2, I would be getting onto the phone with Moni and just saying, hey, Moni, like, I just want to encourage you, go kill it out there. Like, go and smash this topic, because if Moni does her job, if she increases the community, if she increases the conversation, if she increases the demand on the coin, every person who typed one benefits from that. Like, that's what tokenomics are. It looks at set rules, it looks at the dynamic that can change, and it looks at the result of that change in dynamic. The set rules are X amount is being released to our miners, X amount is being pulled off the market through our traders. That's the set rule, which means the dynamic that needs to change to see a realization in value is simply the size of the conversation. How many people are aware? How many people are using the products and services? How many people want the token? That sits with our referral program. We've deliberately created a commissioned community. Bitcoin didn't have it, Ethereum didn't have it, Solana didn't have it. We recognize that that is an accelerator. It can potentially shorten the 3 to 5 year time spans. Because if we go from 60,000 people to 600,000 people to 6 million people, what you're doing is you're increasing the demand 10x, 100x, 1,000x. And that's where we start seeing a coin move from 60 cents to $6 to $60. I've said with absolute confidence to people, this is a multi-$100 coin in the next 3 to 5 years if the conversation grows from 60,000 to 600,000 to 6 million. Fixed supply, fixed release, increase in demand. That's the focus. Now, happy to answer any questions. What I didn't want to do is turn this into a highly technical call, because to be brutally honest, it's not that technical a subject. It's just based on supply and demand. We saw the price of gold grow because there is essentially almost a fixed supply in gold. There's what can come out of the ground, what can be vaulted. And if you have people who want gold, that increases the demand and the value grows. We understand this in just about every marketplace globally. And then the moment someone talks cryptocurrency, we throw those rules out the window and suddenly try to create new ones. Because most of us see what are called hype spikes and we think that's the normal. And so we try to figure out what that rule base is. The hype spikes is not the normal. What is the normal is the conversation in between the hypes. That's supply and demand driven. And that's the conversation we're trying to have with our community. What if? What if it goes from 60,000 to 600,000 to 6 million? What is the mathematical equation that then shows us where the value of the coin will grow? Fixed supply, fixed tokenomics, increase in demand, size of community, increase in value. It's very, very simple. So I'd love to hand back to Moni. There's a lot I could talk on, but I want probably the questions that are coming out of this community to drive the conversation for the next 15 minutes, Moni, if we can, because I do have another call.
Thanks, Bruce. I've got Gil, are you there? Gil was asking about the trading protocol. Why do we only long trade? That was a question, Gil, wasn't it? Do you want to just touch on that?
Yeah.
Yeah.
Yeah, I wasn't aware until I listened to that training on the trading bots that I understand that it doesn't short, it only longs. Now, which essentially means that as long as the coin is in correction or trading down, there's going to be no trading because it's going to buy up all the apertum that's got, going to run out of pair, and then going to just sit there idle. Is there a reason why
And
that's
Gil,
programmed in that way?
yeah, absolutely, Gil. It's a great question. Gil, if you go look at the first, again, 3 to 5 years of any project, what happened, particularly on what's called a fixed release project, is that the majority of coins released are released inside of your first, what we call halving window. So if you go look at apertum, if you go look at Bitcoin, if we've got 2.1 billion apertum, the majority, 50% of that gets released in the first 125 million blocks. And if you go look at projects that do that, the price tends to move sideways or down for that window, which means you want to create protocols that actually absorb as much of that coin as possible off the market in that early window period. You want to reward accumulation behavior. And so what we did is we first launched the mining because you need that for blocks to be created. we then launch the trading bots in order to accumulate off the market. You will see a product launch shortly that'll be what I would call a lockup mechanism or product, where if people take X amount off the market and lock it for a period, they can also earn on that. All of these products in the first phase, that first 3 to 5 year window, will be accumulation-based products. Because you want the community involved in the project to accumulate as much as possible in the early period and remove as much as possible off the open market. So Gil, everything we're creating currently is built towards that ethos, because this is the period we can do that in. You will see trading products launching in the next 3 to 6 months that'll trade in both directions. So in other words, it'll leverage a Apertum, say, against Bitcoin in order for people to realize both the downside and upside. The reality is the majority of our products in this first phase are accumulation based, because that rewards the community over the short term, 3 to 5 years, more so than it trading in and out of markets, like the more larger market cap coins out there, like Bitcoin, like Solana, like, you know, the coins that have been around for 5+ years. It's a great question though. Thank you.
Does that relate to the price of, like, so the $6.25 goal of the coin? Does that really, like, everything's motivated to take the coin to that level then, is what you're saying?
So everything that can reduce supply on the market and increase demand for the coin, that'll push the price up, right?
Yeah.
So if you can create products that reward people for reducing the amount of Apertum out on the open markets, and you can have mechanisms in play, a reward system in play to increase the community, you'll go to $6, you'll go to $60, you'll go to $600. So everything you're seeing that is launching out into the marketplace currently is based on one primary goal: reduce the supply that's going to the market, and 2, increase the size of the market, the number of users. Every other product that's launched around that is what we call secondary. And there's a lot being launched around that is secondary based.
Okay. Geordie, did you want to ask a question now? You're just on mute.
I think he's gone over most of the stuff that I brought up with
Yep.
you.
Yep.
You have. So
Okay. And I can take some of those aspects. And we're touching on Joe's questions around the relationship with Bitcoin. Like, Joe, do you want to just speak to that? Like, if you have a trading bot paired with Bitcoin, I just wanted to see if you could nail that question now.
I managed to get my mute button on when I wanted on this time.
Okay.
Yeah, I mean, I'm still reading and doing my own research on the Apertum coin, but a question that sort of popped up in conversation between myself and Moni was, can you use the Apertum mining bot to mine Apertum and then the trading bot to trade against Bitcoin and effectively accumulate Bitcoin?
Yeah, Joe, so the way that the trading bot works is it trades currently on a decentral exchange. The way decentral exchange works are liquidity pairs, not order books, meaning that Apertum needs to be paired with Bitcoin, and whatever that ratio is how you get price discovery, right? So you got Apertum Bitcoin, Apertum Ethereum, Apertum USDT in its relevant ratios, and that's obviously where the bot then arrives to trade, either buying Apertum using Bitcoin or selling Apertum in order to receive Bitcoin, specific to your question. So if you go buy a mining bot and then you select the pair Apertum Bitcoin, it's going to buy Apertum when it's dropping using Bitcoin. It's then going to sell Apertum when it's rising back into Bitcoin, and then you have Bitcoin as your profit taker, essentially, in that relationship. When you click claim, and this is important to understand, the way the bot is currently wired is it'll take that same Bitcoin, sell it in that moment back into Apertum, because it wants to put buy pressure on Apertum, and put that into your pocket, and then you can exchange that back to Bitcoin if you wished. Okay, everything again is wired currently in order to serve the Apertum ecosystem. But absolutely, that relationship does exist. Now, Joe, I'm going to say something super controversial on here, and I know Moni is recording. So, Moni, if someone gets this recording and edits it out and grabs this little piece, they're going to definitely be able to misrepresent what I'm saying here. But okay. Thanks, Moni. which means that the financial institutions currently, so your MicroStrategies, your Fidelity, your BlackRocks of the world, are actually state capturing something that was beautiful.
Yes.
You're trading, I'm going to say it very honestly, if you're holding Bitcoin and Ethereum, you are now actively trading against a very deliberate machine. Now, the counterpoint that people make is, yeah, but if you look at the math, the majority sits with the retailers. Good luck getting the retail community to row in the same direction. And so I'm just going to say it as it is. Bitcoin and Ethereum do not sit with the people anymore. You are actively up against the same institutions that gave us a failed financial system over the last 54 years.
Yeah.
And I think what we're going to see is a wave of projects that have their own coins. So APTM is just part of that wave, where people are going, how do we create decentralized institutions where the supply goes to the retail market first, not to institutional money? And how do we have decentral exchanges that are based on liquidity pools, not order books, in order for that supply, so the community who controls it, to actually have real value moving between the community? If people understand that, you're going to see projects absolutely explode in this space. If people don't, we're going to end up with cryptocurrency in term and title only as more and more ETFs start capturing the retail market. That's just my opinion on this,
Okay.
as controversial as it might be.
That's hot. Thanks for the tip, Bruce. Hey, Gil's got a question in the box there. Still not clear on what is the incentive for someone to buy a trading bot now, knowing it will only trade longs and we're looking at a long period before the price rises. Can you give us a minute on that one?
I don't think there's an incentive. I think it's part of a strategy. You know, if I want to build a house, I want more than just a hammer. And it's the same for just about anything. You want a toolbox that you can put into the marketplace and do certain activities. So if you've got a toolbox that buys a APTM when it's dropping, you've suddenly created what's called the 97% inoculation tool, right? You've got something that's not going to buy on hype or headline. It's not going to sell on fear or doubt. It's going to do the opposite. That's a useful tool to have. Just like it's useful to have a bit of liquidity to be able to leverage the liquidity pool tool, where you're earning fees based on people trading in and out of the cryptocurrency. Just like it's useful to have a tool that gets the APTM directly from the source before it goes to the market. Just like it's useful to have your own common sense to be able to go and buy or sell a APTM when you wish, based on whatever you see in the chart doing. These are just all tools. The average person doesn't have a tool, and the average person will buy something based on hype and headline, and they will sell it when it's dropping in value because they're scared. And their story will be one of losing value. The incentive is going, how many tools do I have in my toolbox to take advantage of what the markets are doing on automatic? I have trading bots that will buy the coin when it's dropping, regardless of what people are saying on a chat group. And I'm not having to worry about when to buy that APTM. I'm carrying on with my life. I'm taking my boys to go play rugby. I'm having calls like this. That's a useful tool to have, but it's a tool in the toolbox.
Very cool.
If people made the right, I'm going to say it, if the people made the right decision 100% of the time, we'd have a lot more success stories in Bitcoin and a lot less spikes. But apparently people don't make that decision. The same is true for Forex. The same is true for stocks and shares. People seem to be driven by emotion more than analytics. The bots are the opposite. They're driven by analytics. They don't have emotion.
Okay, in the last minute we've got you here, Bruce. What would you do with $1 million if you had it in your pocket right now? Where would you put it?
Right, tools, right? You'd have an effective toolbox. Lots of people try and make an either-or decision. They kind of go, which is a gambling approach. I'm going to be brutally honest, right? Where can I get the maximum value possible from my $1 million? Well, actually, we don't know. But if you've got a range of tools that react to changes in the marketplace and react to price up and down and react to time periods of 3 to 5 year windows, then what you've done is you've got enough tools that your dollar cost average over a time period is probably healthy. So I'm not going to give an answer on what I would do with $1 million. I'd be looking at automation. I'd be looking at accumulation. I'd be looking at keeping enough in my own pocket, what I would put into USDT, to take advantage of moments where you can go, oh, I've got some to deploy into this moment. I prefer having a toolbox, guys. I'm not going to give an answer, an all in. I think it's good to have both and as an answer there.
Thank you so much. Thanks, everyone. Big smiles, Bruce. Appreciate your time. Yeah. Thanks for everyone.
Pleasure, Moni.
That's been great. And yeah, we'll talk again soon, everyone.
Awesome. Thanks, Moni. Thanks for your time. Thanks, everybody else. Have a great evening.
Bye, Bruce. See ya.
Thanks, everyone. Thanks, Bruce.
Thank you.
Thanks, Moni.
Thanks, team. Thanks, Moni. Thanks, Bruce. See you, Tui.
Thanks, Moni.
You're welcome.
I don't know
Hey,
who
John.
said that, but see ya.
Have I got any family there? Oh, there's Jake. Nice. Hello, Doug.
Thanks, Mum.
Pleasure, Christina. Nice to see you. Thanks for jumping on, mate.
Thank you so much.
Pleasure, Alfie. Talk soon, sweetheart.
Yeah. Bye.
Well, that was good.
That was great. That's what we needed. Very good education.
Very clear.
He's good, isn't he?
He switched on. Yeah. Just like that Ed fella.
I
Yeah.
Stop the recording.